Welcome back. We're now going to have a module or a video that looks at the question of how do we evaluate different strategies that are at our disposal. What will be the impact of these strategies? How do we measure their efficiency or effectiveness? Are they working or not? And we'll look at also some stakeholder issues about, well, are the strategies applicable? Will stakeholders be on board? Are they feasible strategies? A whole bunch of things, and let's get started. We'll take a look at, first off, we'll look at some of the basics of how do we go about evaluating a strategy. So a quick reminder where we've been and where we're going. We started out our journey up here looking at strategy, strategic position about what's going on, where are we, what's the environment like, what's the industry like. This was a whole bunch of analysis around the organization and its environment. We then moved down into issues of strategic choices, about corporate strategy, about business strategy and competitive advantage, about going abroad, about M&A issues, and of course about innovation and entrepreneurship. Now we're going to take a little bit deeper dive into the issues of strategy and action. And this is really going to be about how we get strategy done day to day, in the real lives of an organization, where it gets kind of messy, to be quite honest. And in particular, we'll be looking at a few key points with respect to strategy and action. We're first going to look at the evaluation of strategies. How do we assess a strategy? Are they suitable? Are they acceptable? Are they feasible? And to what extent? We'll then look at the process of strategy making. How is strategy decided upon and created in an organization and implemented in an organization? How do we organize for strategy? How do we organize to make sure it's in place? And how do we organize to make sure it's effectively implemented? One of the key elements of strategy and action is obviously leading change and putting strategy into place, and that's the key role of leadership. And so we'll focus on that. And lastly, again, who does what? Some of the practical issues of strategy in an organization. And we'll start with our first module here on evaluating, or the evaluation of strategies. Probably the best way to get an idea of the importance of strategy evaluation is to look at a very simple case. And let's take a look at Carlsberg Brewery. So Carlsberg is a large brewery. In 2015, Carlsberg was faced with declining annual profits. It was also faced with a 25% drop in its share price, quite impressive decrease in the share price of the company. And obviously the leadership of the organization came under scrutiny for this significant fall in share price. And Carlsberg was also found to be underperforming its competitors. And so there was a change in leadership. I mean, the organization basically said, okay, we have to change directions. We need a new leader. And before leaving the organization, the previous CEO made a clear point. He also said, hey, yeah, but we've also increased net revenues in key markets. So this brings up a very interesting point. This brings up the fact that sometimes all of our indicating lights, all of our dashboard lights that we've put into place to evaluate performance of an organization may not all be pointed in the same direction. And so this makes decision making quite difficult. So what went on in Carlsberg and how do we proceed? Well, they asked the question about evaluation, which is what we have right in front of us. They then analyzed some potential strategic options. How can we move forward? They could cut back on cost to protect the company from competition, so more of a defensive posture. They could also say, hey, look, let's broaden our narrow market presence. through acquisitions in high growth markets, because there are markets that are expanding, and expand revenues. We see revenues are increasing. Let's go that way. So a more offensive position. And both are possibly viable. But to really understand which one would be best, they have to analyze the viability of each of those options. Which one will give the performance they want? Maybe the performance of each option depends on how you measure performance. So what's our performance measure? How are we going to select that? Are we going to select it based on, for example, does it align with our strategy? Is it something that's suitable that we can use? It's something we really focused. Is it aligned with our strategic competitive advantage? Is it something that is totally feasible with respect to our stakeholders? Is it something that they want? So there's a lot of issues about, well, choosing the appropriate strategy. And that's what we're going to look at in this chapter. We're going to look at this whole question of how do we evaluate performance, and how do we evaluate the different options in front of us to best choose and make as good a decision as we possibly can. So basically, we'll go through the following. We'll look at assessing performance first. We'll look at the economic assessment of performance, and we'll look at the organizational assessment of performance of a strategy. We'll then look at what's called a gap assessment, or a gap analysis, where we'll compare the performance of the strategy relative to something, relative to a benchmark, relative to our established targets, something that tells us, hey, you know what, we're on track or we're not on track. And based on this analysis, this gap assessment, we can then look into what are some strategic options available to us. If we're off course, well, how can we correct the boat? How can we correct our process? And we'll assess these options on 3 very simple criteria. How suitable is the option vis-a-vis our strategy? Is it something that we can do? Is it acceptable for us? And is it feasible? And we'll dive into each one of these SAF or SAFE criteria. Once the option is made, obviously this feeds back into performance. We put it into place and we say, well, how's it going? And we have this continuous loop on assessing performance, measuring, correcting, assessing, etc. So we start with performance assessment. How are we doing? Is our strategy doing well or not? So performance assessment is done on 2 areas, let's say. The first is economic performance, and the second will be organizational or broader measure of performance that goes beyond a simple economic performance assessment. Well, if we look at simple economic performance of a strategy, it's pretty obvious. We're going to look at some of the critical measures of performance. These could be market-related measures. We've put into place a strategy to maybe grow sales, or to have a certain amount of sales, or have a percentage of the market. We've targeted maybe a certain market share, and we expect to grow that market share. So we'll have some target measures, and we'll be able to monitor sales and growth in sales and market share. We also have some more traditional accounting measures of overall economic performance of the organization in terms of profits, profit margins, return on capital employed. All of these are other indicators. These are accounting indicators of performance. And just like in the case with Carlsberg, some of these can be in conflict. Some of them can be pointing, hey, things look good. Sales are up, but profits are down. And this is one of the things we have to be very, very wary of. Not everything is black and white in performance assessment. So those are basic economic performance, and that's what's done. We can also look at a more broad assessment of performance, and we'll call this organizational effectiveness. And so we look at a broad set of criteria that go beyond. It can include, obviously, these economic measures, but it adds additional elements. Probably the most famous, done by Professors Norton and Kaplan out of Harvard, is the balanced scorecard. So the balanced scorecard basically says, you know what, we're going to look at some of the financial elements that are over here, but we're also going to add in some other elements that we consider to be important to measure organizational effectiveness, how we're performing. These can include, well, what does the customer think of what we're doing? Are they satisfied? Is the quality there? So we take a customer perspective. We could also take a innovation and learning perspective. Hey, you know what? How are we doing in terms of development of new products? And how are we doing in terms of developing new skills of our employees? We can also look at internal businesses. Are we more productive thanks to this new strategy or option we put into place? So it goes beyond sometimes what may be considered some very short-run measures, these financial perspective measures, which sometimes tend to be very short-term oriented. And we try to bring in some other factors that say, you know what, maybe the share price is not where we want it to be, but we've been launching new products, we're renewing the organization, we're developing new skills, our customers are happy, etc., etc., etc. So we get a larger measure. And so here you see an example of a company that defines its various financial measures, customer orientation measures, internal processes, capacity factors, and then they determine key performance indicators and targets for each one of these key performance indicators that are indicators of each of these criteria in these four families in the balanced scorecard. Another obvious measure of organizational effectiveness is what we call the triple bottom line, where instead of just measuring profit, we measure two additional P's, so it's a 3P, profit, people, planet. We'll introduce, in addition to economic measures, some social measures and environmental measures. A good example of that would be Ben & Jerry's ice cream that has successfully implemented a triple bottom line measure of performance that they measure their economic, their social, and obviously our product mission driving what they do. So it's a mix between economic, social, and environmental issues. These obviously, as I said, are things that allow us to assess the long-term prosperity of the organization and look beyond some of the financial measures we see to the left. So let's say we come up with some sort of a measure, whether it's a balanced scorecard measure or a weighted average of some sort or economic or accounting measure of performance, and we get some number. You know, we get 75. I don't know. Throw it out there. Is that good? Is that bad? You know, relative to what? I mean, a number is just a number. And performance has to be measured relative to something. We need it to compare, you know, where we are with where we maybe wanted to be. So we need some sort of a benchmark. We need a comparator to analyze, are we on track? Is it something that we're doing? Are we good or not? A number by itself means nothing. It has to be relative to something. So what are some of the comparisons we can use? Well, some of the comparisons are targets that we fix for ourselves. A typical sales target, for example, or a growth target, or earnings target. And these targets are used, obviously, to assess, to evaluate the organization not only internally, but externally. Companies will fix targets, and whether or not the company meets those targets will have an impact on, for example, the price of the stock of the company. This is something we go public with. We explain where we want to be. It's a target we fixed, and meeting or exceeding those targets will have an impact on what other people think and how they evaluate our company. In this case, Target, which is a large retailer, had mixed fourth quarter results. Some of their targets were okay, as I said. Sometimes it works. And other ones, well, fall short. In this case, Target's earnings expectations were okay, but revenues fell short because of weak sales. So again, we can compare where we are with where we said we would like to be. Another way we can measure performance is over time, or over many, many years. We can take a step back and look at our performance and see, are we going in the right direction? Are we moving in the right direction? Here's an example of Netflix. And this is an example of, for example, well, maybe they were looking at the number of subscribers. And they've got US subscribers that seems to be trending upwards, and international subscribers that are becoming a larger and larger share of what they want. So we can see if things are improving or declining. But again, just looking at this graph, you could say, well, things look good and Netflix is doing really, really well. Well, again, this depends on what they wanted. I mean, maybe what they wanted was something like this. And hey, you know what? National sales are on track, but maybe they were expecting much more international sales. And so even though it's going up, again, where do we want to be? And lastly, we could benchmark our company, and we can compare it to other organizations. We can compare overall performance, or we could compare specific processes. If we have an innovation process, we can compare it to best-in-class innovators. If we have other processes, we can always look for the best-in-class and compare specific processes with best-in-class. So, for example, you may see United Airlines looks pretty good. Performance is going, but relative to maybe a market leader, it's not as good as they're performing. So, yeah, we're performing well, but if we compare it to another organization, well, maybe we could do better. So, we have 3 different ways we can assess our performance: through our own organizational targets, through trends, and through comparing or benchmarking performance relative to other organizations. And trust me, if you're underperforming a competitor, this will show in the stock market, for example. So what do? We've got our measure of performance, we've got our level of achieved performance, and we're moving forward, and we see that there's a small gap that's occurred. We've got desired level here, we've got achieved performance here, and currently we have a small gap. Is this a concern? Well, it's not a very big gap, at least, based on this drawing. What about in the future? Well, we can project in the future based on where we want to be, and if we continue doing what we're doing, where will we be? And wow, the gap suddenly gets a little bit bigger. And so, given the projected gap of where we might be ending up, then we may want to drop some options to correct our current path of evolution. And this then asks the question, we've got this gap. How do we fill the gap? How do we adjust our current performance and projected performance to become more in line with where we really want to be? How do we close this gap? And so now we'll have to consider the question of, okay, we have various strategies to move forward to close that gap. We now need to assess those different strategies to move forward and choose the most appropriate one. To do this, we'll introduce 3 criteria. And SAF, you can add the E here for evaluation, give us safe. S for suitable, A for acceptable, and F for feasible. And so what we'll do is we'll take this acronym apart, one by one, and we'll discover some of the key criteria for evaluating strategic options that we're going to put forward to close that performance gap. The first of these criteria is suitability. And suitability is concerned with assessing which proposed strategies address the key opportunities and threats that we face. Now we know, based on previous chapters, that we're looking to use and assess our strengths, weaknesses, opportunities, and threats We want to capitalize. If we've got something that's suitable, it allows us to capitalize on our strengths. It's something that, hey, we're good at this. Let's use that moving forward. A suitable strategic option also will help us to avoid or possibly remedy the weaknesses that we have within our organization. A suitable strategy will also exploit potential opportunities that we have. And lastly, obviously, to avoid or neutralize potential threats. Now, we've studied a lot of the tools used to do this type of an assessment, a SWOT assessment. Under each of these items and under the SWOT assessment, we'll find obviously the PEST analysis, the Porter-esque analysis, the VRIO analysis, the cultural analysis. All these are elements of either measuring the external environment or the internal environment. So if we take a look back at some of the measures we've used, the PESTEL analysis is going to help us understand the key drivers. And obviously a suitable strategy using the PEST analysis will consider, well, what's going on with the industry? What are the key changes? And does the strategy fit with what we're seeing in our PESTEL analysis? What about scenarios? Does the strategy that we're proposing fit with the various scenarios that are coming out? What about the 5 forces? Is a certain strategy reducing, for example, rivalry? Is it allowing us to build barriers to entry? Is it allowing us to take advantage of certain strengths that we've got relative to suppliers and buyers? So all of the tools we've seen in the past allow us to assess the suitability of any particular strategy. Likewise, we've looked at various strategic options already. We've looked into the question of diversification. We've looked into questions of mergers and acquisitions, into alliances. We've looked into different growth strategies with the Ansoff matrix. And again, are these different strategies, suitable for our current industry and the resources we've got? And this is the actual use of these tools that we've had in the past and we've discovered to assess whether a strategic option is suitable in terms of the industry and also internal resources and capabilities. Does it fit with what we know about our external environment and about our internal strengths and weaknesses? Second way we can go about, or second family of types of tools we can use to evaluate strategic options, would be the use of some sort of a ranking tool or a weighted ranking tool. And again, in a lot of these issues, when we start ranking suitability or strategic options, the actual number that we pump out of the assessment doesn't mean a lot, but it allows us to rank a given strategy. So here you've got, for example, 3 strategic options, and we've identified some of the key trends that are shaping the competitive arena, the key drivers that we need to make sure we're succeeding at developing. For example, if we're a low-cost industry, low-cost company, what are some of the key drivers we need to succeed at? What are some of the key drivers in our differentiation strategy, etc.? So here we've got a company that's got, for example, 3 strategic options. They basically have identified, we need to respond to the slowing growth of the industry. We need to respond to the change of tastes of our consumers. We know that barriers are becoming lower. Is this strategy going to meet the increased threat we're going to have from potential entrants? We have a strategic problem because maybe we're losing patent protection on something we've created. And hey, you know what? Our stakeholders are becoming more and more concerned about corporate social responsibility. So these are some of the key factors we've identified here. We've come up with a weighting scheme for us. What's more important right now and in the future of all these criteria? We assign a grade for each. We analyze it, and we come up with a score. Now, what's important with a lot of these assessment tools is that we're actually going to sit down and debate and discuss and come up with a measure. A relative measure is one outperforming another one. And that's one of the key advantages of a lot of these tools, is it allows us to debate and analyze and really sit down as a leadership team and come up with this evaluation or assessment. Another useful tool to assess suitability is the use of scenarios. We've spoken about scenario planning and scenarios in the past. So just like we have with this weighted ranking scheme, we could basically say, well, we've got multiple scenarios here. Scenario 1, Scenario 2, Scenario 3 for the environment. This is what Shell Oil does for its strategies. And what we'll do is we'll take each strategy and we'll ask, well, does it survive the stress test? How well does it do if this scenario here, Scenario 1, actually happens? How will we come out? How will our strategy affect us? How will we perform if, Scenario 2 happens in the environment? And what about Scenario 3? And so we come up with a measure of performance of the organization based on whether Scenario 1, 2, or 3, come to light. And we come up with a score. And we can take our strategic options and look at them through the lens of each one of these different scenarios and give it a ranking. And in this case, we see that strategic option 2 seems to perform the best. It's more maybe resilient to changes or these different scenarios. If Scenario 1, 2, or 3 happen, well, performance is on a scale of 10, 6, 7, or 6, so that's not bad. I mean, and we don't know if 1, 2, or 3 is going to happen. So maybe today, let's go with strategic option 2. But let's leave the door open. Let's leave the door open because strategic option 1 looks like if Scenario 2 over time starts to look more and more probable as time advances, and maybe Scenario 2 will actually come true, can we flip over to option 1? And so what we'll do in this case is we'll keep an option. We'll keep this open in case Scenario 2 becomes more and more certain. And that's how we can manage our organization over time. We can also screen on the basis of competitive advantage, and we've seen this before. V for value. Is a scenario, or pardon me, is a strategic option going to create value for customers and for the organization? Will it take advantage of the rarity of required assets? Is the strategy a strategic option tough to copy or imitate? And lastly, does the strategic option allow us to, does it support it by the organization? So again, pretty basic. What we'll do is we'll take our different options and we'll ask, the question, well, does this option create value? Is there rarity of required assets? Is this option easily copied or imitated? Do we have the support to implement each option? So we take our options and we basically assess them, using the VRIO plan. And again, here we've got strategic option 2 that seems to add value, appears to use rare assets, basically is difficult to copy or imitate, and we're ready to support it. So strategic option 2 seems to, from this angle, be the most appropriate strategy if we look at what are the internal bases of competitive advantage. Another tool we can use is our decision trees. So decision trees are kind of like a series of what if and if then type questions. So strategic decision tree is pretty easy to see. It's pretty easy to see what it looks like. Imagine we have 3 criteria for our strategy. We're interested in growing our company, and a strategic option either it helps us grow, or maybe it doesn't. The second criteria could be, well, we want to increase the return on investment of our next strategic option. We want to make sure we have a high ROI. Some of our strategic options may have a high ROI short term, some maybe not. And so we have to assess, well, yes and no. And a third criteria could be, well, does the strategic option provide us increased agility as we grow? Are we able to become more resilient over time? And are we able to adjust quickly if we put into place a particular option? Or are we going to be committed and we decrease our agility over time? And so for each of these criteria, we either can or can't in this simple decision tree. And now we can line up the various strategic options that are going to match this flow of decisions. So imagine now we've got all these criteria, and we now have to step back and say, well, which of these criteria are really important? Well, let's take an example. Imagine that all three criteria are important. Well, in that case, strategic option 1 looks the best because it's allowing us to become more agile. It's meeting maybe a short-term need for high return on investment, and it's allowing us to grow. It's meeting the yes criteria for all of these conditions. But maybe we don't really care about all three. We care about maybe high ROI and agility. Well, in that case, we have two potential candidates that allow us to meet those criteria. And this is a decision tree. Now, this is a very simple process, or a simplistic approach, because it only uses this yes-no assessment. It could be much more detailed if we wanted it. But it's a starting point. It allows us basically to filter in or filter out various options that don't meet criteria. And then we can go head-to-head with these two maybe and say, well, okay, which one's best? And a last tool for assessing suitability would be to look at a strategic option through the lens of the life cycle of the industry and where we are. And we know that industries go through life cycles, through development, through the growth stage, the shakeout stage when competition starts becoming fierce, maturity, and industry decline. And a strategic option or an effective strategic option will depend upon our current position. Where are we? Are we a strong competitor? Are we middle of the road? Are we a weak competitor? Well, let's take the condition of the strong competitor. If a strong competitor is in the development stage, a strategic option should hopefully allow it to quickly grow and be aggressive. We know this is the startup of an industry. A good strategy is something that will allow us to seize a strong competitive position and grow aggressively. If we're in the growth stage and we're seen as a strong competitor, the growth stage is again where we have to shine and where we have to start differentiating. We have to broaden our scope. We can really see some advantages. In the shakeout period, well, we're the leader and other people are coming in. So what are we going to do? We're going to drive out or acquire the weak. And we're going to reinforce our competitive advantage because we are the leader during a shakeout when, the weak won't survive. When the industry is mature, a strong competitive organization will start consolidating, building its position, maybe acquiring smaller companies. We'll harvest off our weak activities that aren't making significant revenue and profit. We'll start cutting costs. And in decline, what do we want to do? We want to be eventually the only people left. So we'll drive our competitors, we'll cut our costs, and we'll exploit any power that we have relative to our competitors. Now, the strategic options, the options that are best are different if we're in the middle or in a weak position. And what we'll see is that these strategic options will be similar to these ones, but we'll do it earlier. So for example, here we've got a middle competitive position, and what we'll see is that while the strong company is looking at going into M&A maybe activities, when the industry is mature, the middle of the road competitor, the not so strong competitor, will seek to do those M&A activities before well, the strong ones start doing it. If I'm a middle competitive company, if I'm middle of the road, if I'm not a strong competitor, if I wait too long to start seeking out acquisitions, well, the strong competitors will get the acquisitions that I was hoping to get, and I will not be able to get them. So I've got to play before they play. And the strategic option for me has to happen before the strong competitors. And same with the weak. And so what we see is that a lot of the decisions, okay, that are being taken, consolidation, M&A, 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 focus on the niche, focus, reinforce, differentiate, differentiate. All of these different activities are happening at an earlier stage because the weak know that if they wait too long to start seeking an acquisition, the middle people will have already achieved it, and even the strong leaders will have achieved it. So they got to move earlier. So that covers basically the suitability factor. And we've assessed whether a strategic option is or is not more or less suitable for who we are and what our strategy is.